All right, so stocks finished the week on a little bit of a down note. In fact, a 4-day losing streak. We just don't get many of those here lately. But I'm going to break down today whether or not that's actually a trend-changing event or not, and that's the key, right? There's lots of noise, up and down noise, and we are in this kind of noisy territory, and we're looking for signs that it's more than just noise. Even on the near-term basis, is it more than just noise, and is that bearish divergence playing out? So I'm going to break down how we finish the week here and how we look going into a new week, and what to expect from the weekly patterns that we're seeing on the since we finished the week. We get weekly charts. Let's take a look at what patterns we're seeing there, as well as on those daily charts. So we're going to break all that down. What's driving this action? Some significant moves in the bond market and the dollar, U.S. dollar. So we're going to break down what that means and how that affects our market posture and our trade idea of the day. Kind of taking it easy and making sure we can manage our risk appropriately in a market that's still in a bullish trend. But the question is, how much more do we have, especially heading into this March expiration? So let's go ahead and get started. Today is Friday, February the 19th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the market forecast indicator here. As you can see, we finished the week on a down note. 4 days this week, finishing with a close to the downside. So not necessarily the greatest, but you notice still easily inside the 0 to 23% area of the current intermediate rally that we're on off of this low point here. And for that matter, also between the 0 and 23% level of the near-term rally, the blue line rally that we're on, that just barely ended because the blue line finished Friday down below the 50th percentile. But you still have a very strong intermediate posture. You have a very strong long-term market sentiment line. Everything is still relatively bullish from that perspective. And neither one of these short-term sentiment lines are giving you any indications yet that the exhale is starting, right? Especially with a strong trend. Even though we got a cluster over here, and even though we're on a 4-day losing streak, that still hasn't made a significant dent in those expectations. You can see short-term sentiment lines for the Dow are still in the upper half of the chart, as we haven't had nearly the decline with the strong intermediate posture and long-term sentiment. Same thing here, but the NASDAQ kind of influencing. It actually is down below its 23% retracement of the near-term rally, but still obviously easily above the 23% retracement of the intermediate rally here. So still a very noisy move there. And then finally the Russell actually bounced on Friday. It actually rallied here. Strong posture with short-term sentiment, which was bearish and was giving you an oversold a bullish intermediate confirmation signal on Friday, bouncing off of that on Thursday into the close on Friday. So very good run here for the Russell 2000, especially closing up above Thursday's high. So a decent bounce. If you look at the market sentiment line here, the weekly market forecast. Remember, we got the overbought cluster the prior week. Then we got a really small range. We went from a 52-point range to a 65-point range. It was still pretty small compared to the 169-point range and 177-point range a couple weeks prior. The momentum line dropping to oversold levels. Intermediate posture still high. The near-term line still strongly bullish. So, that would suggest that we would finish this week to the upside, coming off of that short-term sentiment. We'll see if that ends up being the case. Keep in mind that we have one more week left in the month, so at the end of this week we will be finishing a monthly candle, and this is what the monthly candle looks like. So we did have the same kind of pattern on the weekly chart. We had that off a January candle, this bullish intermediate confirmation signal with strong intermediate posture and long-term market sentiment too, and near-term line with a cluster, coming off of a cluster there. Well, we bounced off of that in the month of February so far. So very, very, very good candle there. And then again, that's kind of what you would expect to see, very similar type of pattern here. All right, well, this week you would expect us to be a little bit to the upside, bullish to the upside here. So that's kind of how we're kind of viewing the market forecast, again, not very much of a trend, and this near-term divergence here that has the lower highs with the higher highs, again, that puts that February 10th low point, which happens to be the 23% retracement of the near-term line, into question. So that's the low that you have to break below if we are going to indeed change this intermediate trend to a bearish trend, right? I mean, right now it's strongly bullish with a dark green shading and a green line, but if we're going to have any kind of light pink shading, if we're going to have any kind of dark pink shading, and actually break to this 23% level, which is pretty significantly below the moving average now, if we're going to break down below that and then flirt with an actual intermediate pullback, then you've got to break below that Wednesday low point first, right? That near-term divergence has to play itself out. And as of right now, we did hit the Wednesday low on Thursday's low, has bounced off of it, and we'll see if we continue to stay off of it heading into a new week. All right, so before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and you want us to do another video again tomorrow or on Monday. It's a quick way to give us feedback. If you like our videos. If you don't like our videos, of course, you don't have to click on anything. But if you do and you want to let us know, you can do it right now, actually, while you're watching. Just one click on that thumbs up icon. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those down in the comment section. Join our website at marketscholars.com for free. There's a link popping out up there in the top right corner of your screen. You get access to our Market Outlook forums as part of your free subscription on our website. So make sure you check that out. Follow me on Twitter for more content in between the videos from day to day. There's my handle here at DavidSettle42, and join our Market Outlook Facebook group that we've created. Of course, if you're watching us on our website here, check out some of these other things, including our classes and our Market Outlook live videos. I do a Market Outlook live every day. I do the Market Outlook, so Monday, Wednesday, Friday. I review all the old trade ideas that we're currently still in, and we talk about whether we should stay in them or close them. So check those out there. Of course, our trading rooms, that you can see all of our trading rooms up here when you click on trading rooms. And then finally, come down here, hit this heart. It opens up this new tab. Hit that like button right there. Also hit this thumbs up icon. That takes you to your Facebook page. Come down here and hit this like button right there. Again, the more you do that, the more people will see our content. It will reach more people with more likes and comments and things. Of course, it also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us here. All right, if you take a look at the weekly chart now, you'll see that we got a pretty decent, it's a very, very similar pattern here than what we saw pre-COVID, where you had a couple transition candles on an already mature trend that did not turn into a reversal. We had a couple more bullish candles coming out of that, with the second bullish not being quite. Well, that's kind of like what we're seeing right here, where, again, next week's open is going to be right around 38.90 in that range. We're at 39.06, so we're not very far. We could easily flirt with that and have another transition candle this week. That obviously this week turned into something a little bit more than that. But in fact, the difference though between, well, you can kind of see like that week we had a little bit of a, we had a couple good strong weeks here. In fact, let me just make sure that's the case. Yeah, so that week right there, the week of the 17th, which ended up being a smaller but still bullish candle, Heikin-Ashi candle. That's what it looked like there, and that's what, it kind of, again, almost looks almost exactly the same, except this candle here was 2 weeks because of a big gap down there. But then a big bounce and then a follow through, a big bounce and a follow through, and a small bearish week and a small bearish week here. I'm not saying we're going to gap down big Monday morning and have a big drop from the get-go, but and because it's, obviously we're not in the same environment here. It's not a COVID virus. We're not that far. We are pretty far up above the 200-day moving average, actually farther up above it than we were here. So it's very unlikely we'd get that kind of move all in 1 week to go from significantly above it, the 50-day to be above the 50-day moving average, which is significantly above the 200, and then be below the 200 the very next week. That's not going to happen. Probably like less than like 1/100% likelihood. But regardless, in terms of like signs of a maturing intermediate run, it looks very, very similar there. When it looks like we were going to start that pullback and then we don't here, very, very similar type situation. Let's take a look at the 3 green arrow chart, and you'll see we did get 1 red arrow on Friday with an increase in volume here, but going into expiration. So what the 2-line versions look like. Into the MACD crossing over its moving average. Stochastic already had crossed over its moving average, but both are still relatively high levels. We are still, easily above the 8-day moving average. So there's no significant drop there yet. Of course, we have to really be kind of, breaking that 17-day moving average if we're going to be worried about any kind of significant decline. Of course, in the pre-market, we're already down there. We'll see if that holds true by the time we actually get to the market open, the U.S. market open. Let's take a look at how these other indexes are playing out. The ADX is about as low as it can possibly be on the U.S., so no trend. Last time we were this low, we were kind of in this area. We had the significant rally, and that's what culminated, and then we stopped. Well, this looks like it's the end of this current bullish rally with this little bit of a divergent high point here. Again, similar to the pre-COVID level where we had our culmination here and then another pre-COVID high, and where the ADX was falling, and same thing but just at lower levels, right, with lower highs on the positive index, higher lows on the negative index. You can see the Ichimoku cloud telling us that we're kind of now weakening with that trend noise balance, and if if a bearish day plays out today, you could very well be ending that run, but there still is a pretty decent gap before you get to the 26-day midpoint, which is what the blue line measures there. And then finally, from a Bollinger Bandwidth standpoint, we're still in the middle, so we're not even below the midpoint yet, which is the midpoint of this is right around, let's see, I have to come over here a little, so 386.37. So again, at the current pre-market, we're not anywhere close to that 386 yet, so we're still going to be kind of in the middle of this Bollinger Bandwidth, at the open at least, and we'll see how that plays out going into the morning, the next day. So we're not necessarily too bearish yet, though. We just want to kind of keep our eyes and seeing how we start to. Remember, the more bearish usually you start, and if you're not significantly bearish, right, if we don't start off with a tremendous move to the downside, and that's, when I say tremendous, like a gap of, what is this, about 1.5% is what we'd be shooting for based on that line. So if we get a gap of down 1.5% or more, now we're kind of talking about the potential size of a gap that could lead to what we saw pre-COVID, right? So over there, we started with a pretty significant gap to the downside on that 224 that started a bearish move that next week after that similar weekly pattern that I showed you previously. If we take a look at the intraday range here, so again, kind of this 387.5 level is a very important level, especially where we end up opening by the time the U.S. market opens, because again, there's a big volume gap down to about 382, 383, and those are some important numbers. And then once you get below that level, there's not a whole lot of support, and especially when you look at the 4-week chart for small caps, there's a pretty decent size gap in volume down to about 215 here, if that's where we end up dropping down at the open, or by the end of the day, or by the end of the next day or two. So very small, small support levels that could that don't have a whole lot of staying power to hold us up above that 23% retracement. So, but that's what we're going to be watching for. Those are the key indications as to whether that exhale is beginning or not. Especially with how the VIX ends up starting out. Remember, the VIX ended the week still at relatively, extremely low levels, down here at the 80% mark and just a little bit below 22. So that's going to be also another sign to watch for. Is it's very rare for us to go from 80% all the way up to 100 to 105%. In fact, that's kind of where things differ a little bit with the pre-COVID move over here. So by the time we got to that 224 level, we had been at extremely low levels, but we were working our way up and had gone through in the early part of February through the neutral zone up to about 100%, and then came and tested the 90%, and then we broke out. So again, we didn't go from extremes, which is this is about where we're at right now, or even over here. We didn't go from here to 105% in one day or 1 week even. It took a few weeks. So that's a one difference now versus then. We were below 15 at the time, but still above 90%. Here we're above 20, but we're still trading right around 80%. So very complacent market heading into a new week that's not nearly as concerned with any kind of imminent exhale. So to summarize, the market, still very strongly bullish, and yeah, there are some indications of some bearishness in the pre-market, but nothing yet that's significant. And there are some levels that we want to watch for heading into this new week, but and there are some signs that before the COVID market lows hit, some very similar patterns developing now at the end of a mature intermediate run that we saw then. But you also still have a good market forecast pattern that suggests we might have a pretty decent week here despite the lower open. We might start filling in. We might spend the rest of the week filling in whatever gap we might have in the morning, the rest of the week as we head into a new new expiration cycle, new up until March expiration. So that's kind of how I'm looking at things. Again, there is a widely expected intermediate pullback that will start someday. Doesn't look like today yet. Based on how we closed last week, will be that day. Obviously we're seeing more and more signs of it, but just not the indications yet that it's that it's imminent, as in within the next day or two. Probably another week or 2 or 3, maybe into that March expiration by the time we get the catalyst necessary to start that exhale. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below what you're thinking, especially if you disagree. What are you seeing that suggests why you're a lot more bullish than I am, or that you're a lot more bearish than I am? All right, let's take a look at how things performed and what really drove the markets here this Friday and then this past week. You can see commodities are really making a big run, and bonds are really falling. And this is very, very inflationary patterns here. The dollar is started off the week relatively strong. That pushed gold down, but then came down off of its highs by the end of the week. And you can see stocks are not responding to these higher yields very well and higher commodity prices. They're under a little bit of pressure, especially from the QQQ. So what that means is you still have this ratio here, and this is a parabolic move going on right now in high beta names in the S&P 500 relative to low volatility. So that's definitely something to be aware of. That was asked in our Q&A session on Saturday. So that's a pretty decent parabolic move that hasn't changed. Obviously, the Q's outperformance versus Russell, that parabolic move has come down. It's actually gone negative here, but it's starting to look a little positive. It's not quite yet, as you can see. If I go back to like a 1-year chart on this, we tested the 30-day moving average again, but then came well off of it on Friday. As you see, on Friday, the relative strength of the Qs relative to small caps really struggled, right? I mean, they were kind of hand in hand. In fact, you can see down here, small caps were down on Thursday about 3% for the week, and QQQ was only down about 1%. Well, that flipped. Small caps were down less than 1% by the end of the day, Friday, but the Qs were down more. So, in fact, if you just look at Friday, you can see how things, were so crazy bullish for the Russell, but not so much for the S&P or the Qs, and bullish as well for gold and a little bit on commodities, though they came off of its highs. with a bearish dollar and and a really significant drop in bond prices. And of course, that's the big move right now going on. It's in TNX. As you can see, the breakout there, it's really getting going. It's up, to the PPO is up to really high levels. Here, let's pull up this PPO so we can kind of see how. I'll take this one off. We can kind of see where the record, where it is on a record basis. Let's go out over, say, 20 years. You can see we're in the 91st percentile. A lot of people are comparing this move to the taper tantrum when they started to price in the taper in 2013. That didn't start until the beginning of 2014 is when the actual tapering started, and you can see that's where we peaked. But the big rise in yields, a lot of people are kind of pointing to the similar type move now as we got then. And we also got that kind of move here at the end of 2016 coming out of the elections, where there was a big expectation that yields would, the dollar, big U.S. focus from a fiscal standpoint, and that sent yields significantly higher there. Well, we are again, but the difference is both of these levels were coming off a relatively negative. I mean, at least in the taper tantrum coming out of the credit downgrade, which was, a negative 20% there, and then this divergence sent you up to that point. And then over here, we were down about 12% negative. Well, we were down 40% at these lows. So I would imagine that we'll get to a higher level peak than we did in either of these two peaks, not because we're any more bullish now or expectations are any more bullish now, but we're coming off a much more significant low point, and that will send us up to probably a bigger high point by the time all is said and done here. So that's kind of what I'm seeing here. Very, very significant breakout there, and you can see what it looks like on the daily chart. The market forecast about as strongly bullish as you can be, and we just continue to push higher. In fact, if you look at the weekly market forecast, very, very strong. There's your breakout and a very, very strong move. In fact, if you look at the inverse of this on the bandwidth, so you can see the volume, and let's go out to a little bit longer time frame. So let's go out to like a 3-year time frame. So let's go 2 years. We don't have to go to 3 years. There we go. So there's our move to the downside, heading towards 50% retracement. I guess I do have to go to 3 years, don't I? So you can see the retracement line. So there we go. So coming off of this low point when the bullish move started, we are headed down. There's some significant volume in this area, but it looks like we're headed towards this kind of 135 area in TLT. We're at 143 right now. So like I said, probably a little bit more run left in the TNX to go to the upside before all is said and done. And it's actually IEF is more closely related to the 10-year note, and that would put us down towards 110 by the time we get to that level. If we were to use the same Fibonacci retracement line, long-term Fibonacci retracement lines coming off of this low point down here up to right around that high point up there. You can see, that 110 level would be kind of in the midpoint of the Fibonacci retracement zone. So still a lot of room for IEF to drop, which again, like I said, is more closely related to TNX than TLT. TLT would be more related to TYX, right? And the moves that it can get up to about 2.5%, if not a little bit higher there. At current inflation expectation levels. Of course, that's also having an impact on the dollar. All right, so that's something we've been watching really closely as well here in terms of a driver for risk appetite. And you can see the transition candles we've been getting and continue to get, and it's kind of flat here so far, but we'll see if these transition candles turn into a bullish bounce, or instead of a bullish bounce, we get a few more transitions, or if we get a move back down. So something similar to where we got this bullish bounce here after a few transitions, or if we just roll over a little bit. So that's kind of how I'm viewing to see what we're expected to get on the dollar or the euro US dollar. You can see it has a pretty decent tradition or pattern of bouncing off the 50, maybe flirting with a little bit and bouncing off the 50. We've been pulling back in the euro, but not in any other asset class, risk asset class, and that's a little bit of a difference in what we're seeing. The correlation, the strong correlation between the S&P and the euro. Something else we looked at in our Q&A session on Saturday, pretty much hit 0%. So that might be telling us that now things are changing from a correlation standpoint that may lead us down to, again, that 1770 level that I pointed to before as a potential target to the downside on the euro, or move to the upside, of course, on the dollar. Again, you can see kind of like the inflationary aspects here. Energy, to a smaller degree, materials and industrials, but energy really led this week. Financials led this week because of the rising yields. And then on the other hand, you have technology and utilities, which are not typically the same. They don't typically go hand in hand, but when you're in this kind of inflationary environment that's putting pressure on risk assets right now, it's also putting pressure on utilities. They don't do well when yields are rising. Utilities don't, and either do staples or real estate for that matter. So kind of an interesting little return back to the kind of small sector weighting sectors in the S&P 500. We haven't had that kind of move here for a while, where these smaller sectors have outpaced the bigger weighted sectors, the technology, communication services, and discretionary. If you take a look at their 12 grid here, right here, then you can see a little bit of light pink shading, some dark pink on staples and utilities. Again, kind of yields response to interest rate sensitive. You can see the bearishness though showing up on technology. Look at that cluster on communication services. We're already light pink on discretionary, while these smaller cap sector weighting, these four right here in the middle of these, they have very, very small weightings in the S&P 500. They also look really bullish. And then look at healthcare breaking down and giving us dark red line, and close to giving us dark pink shading. So you can see a little bit of a rotation that's going on in the sector rotation in the U.S. equity markets. Maybe one last hurrah where these outperform before the bigger sectors bring it. Because again, in a market cap weighted index, small sector weightings can't lead the market for a long time, only in short spurts. Eventually, the large cap weightings will drive the market one way or the other, and has been driving the market bullish. But if there is any kind of weakness there, it can be offset temporarily by these smaller sectors, but eventually smaller sector weightings, even though those sectors can be pretty large, but they're smaller sector weightings, eventually these larger cap weightings will dictate, will take over the baton, so to speak. And like I said, like I've told you before, this chart, when it turns to the upside, it won't turn to the upside initially when the markets are bullish. It will actually turn to the upside as we are starting that intermediate exhale. All right, so for our trade idea of the day, I want to take a look at Boeing. And you can see Boeing had a really good end of the week here, and it's been trying to get going on this 3 green arrow pattern here. A little bit of a jump in volume. You can see from a market forecast perspective, Boeing is turning dark green shading, green line, after a day of light pink shading and yellow line. So the intermediate line above its market sentiment, it's up into the upper reversal zone. If you take a look at the bandwidth, this is something that really stands out on Boeing. Very similar to a bunch of other companies too, that you can see that it has a excuse me. Let's do a chart. There we go. Let's go 2 years. You can see it has a very very little volume of above, and we're up here. Been flirting with the upper quartile of the range. We are down a little bit in the pre-market because of bad news over the weekend with one of its planes, down to 209, 209 and a half. But in fact, if you take a look at the 3 green arrow chart of where that would be, you're looking at right just a smidgen below the 17-day moving average. So we'll see how that opens up by the time all is said and done, especially when you're adding on the kind of broader risk-off moves here early in the morning. If you take a look at some of these other charts, RSI and CCI, we're trying to get up into the upper, kind of the bullish territory. We're kind of been in this neutral territory for so long. We did make one little breakout there before pulling back, and now trying to make another little breakout to the upside. You can see from a directional movement standpoint, same thing. Your positive index is above 25, the negative is trying to get below 20. The ADX is so low because they're so next to each other. Then once they expand out, that's when you're looking for the breakout. From a crossover standpoint here, you can see we're just getting a golden cross. We've tested the 200-day moving average after breaking above it. Now looks like we're trying to break back up above it again. So it has an opportunity here for kind of a longer term trade. In fact, that's what we ended up doing. We ended up going out to June, coming down here to an out of the money call option. That allows us to not put a stop order on it. So like a move like today and this morning won't impact us nearly as much because we have a much lower delta than if we were to say in the money with a 70 delta. And our gamma is not as big as you get further away from the at the money. So that allows us to be a little bit more flexible with the stock, especially on a move, a volatile move like we're going to see once the market opens up here in the morning. All right, well, that does it for today. As always, you've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. You can open up any new thread with any questions or comments you have there. Remember, you get access to that with your free subscription to our site. Reply to other people's threads, and let's keep this conversation going. As always, thank you for watching. Have a great rest of your weekend, everybody. Remember to subscribe to our YouTube channel. Hit that thumbs up icon, comment and on our video, and follow us on Twitter and Facebook too. Again, have a great rest of your weekend, and we'll see you all on Monday.